Good evening, y'all. Welcome to another episode of Everything You Need and Want to Know About Buying Your First Home. So, tonight begins our journey into the wonderful world of loans and lenders. This is probably going to be very long. No, probably not because I don't want to talk about it too long. But there's a lot you need to know. I'm not going to get all the way deep down into a whole loan package. That may come at the end when we talk about closings. But just for this point, we're just going to, kind of go over the most important things when it comes to loans and lenders. If you watch my other videos, you know that I'm promoting what Dave promotes, which is that you get a 15-year fixed rate conventional mortgage because in the long run, you're going to pay less. But then I just thought of something. I was like, y'all probably don't really understand what a 15-year fixed rate mortgage, like what exactly does that mean? Like compared to what? So I'm like, hey, let me break it down for you all so you can make an informed decision related to your other options when it comes to getting a loan. Because even though the fixed rate conventional mortgage is the ideal, we all know that our situations aren't always ideal. So I want you to make the best decision based off of where you're currently at financially, mentally, job wise, whatever. Granted, we should all strive for the ideal, but I know better than most that sometimes we have to settle. So if you're going to settle, I want you to at least settle for second best. That way you can make a more informed decision because, with a 15-year, it may take you a long time to save up for a down payment because the thing is, you can save up and just tell your lender, hey, I want to do a 15-year mortgage. But then you have to consider other factors. Like, you're going to have a budget that you follow strenuously. You got to, of course, your lender looks at your debt to income ratio, but it's going to be a lot of things that you're going to have to cut out if you're going to be paying a 15-year mortgage versus a 30-year mortgage because you're going to be making higher payments. So you may not be able to do that. But we'll get into that. So this video, we're talking about 15-year mortgages, what it is, pros and cons. All right, y'all ready for this? Let's do it. Let me define a 15-year mortgage. A 15-year mortgage is a loan that's going to be paid off in 15 years. Boop. Typically, they have a fixed rate, so that means that your monthly payment is going to be the same throughout the term of the loan, except that's, unless your taxes and your insurance, homeowner's insurance change, because those are things that your lender has no control over. Taxes are set by the county or the city that you're living in. So taxes, they can go up or down. Property values go up, your taxes going to go up. Property values go down, your taxes going to go down. Insurance, that changes based on a lot of things. I don't know, maybe if you have I don't know how the insurance is affected. I don't know. Maybe if there's a lot of break-ins in your neighborhood, then your insurance rate could go up too. So, yeah. So, that right there. You have it. And the thing is what's suggested by, I think it's NerdWallet. They said that, for a 15-year mortgage to work, you need to have a reliable income and enough money left over after your monthly payments to cover expenses, savings, and emergencies. Now, in the other videos, we talked about finding out how much house you can afford. I don't think I explained to you all that, that's how much house you can afford, but basically you shouldn't try to go for the maximum because you're not including your debts. You know what I'm saying? Lenders, I guess they do that later on. That's where the whole debt to income ratio comes in, and then they further decide how much house you can afford. But so go look back at the other video where it talks about finding out how much house you can afford. That right there. And it may be based off of that, your monthly payment at the highest could be $12,000. But then if you got like buku debt, shit, it just brings it down a little bit lower because, you know what I'm saying, a lot of that money may be having to go toward paying off debts besides your house debt. So that really affects what kind of house you can buy. So yeah, it's your fault. Get out of debt. That's why we're pushing. Get out of debt, okay? Because then it may not matter if you have a 15-year mortgage. Because if you have no debt, of course, more of your money can go toward a house or, you know, contributing toward investments or savings or just going out and having fun. So, yeah. Anyway, we're going to get into the pros and cons of a 15-year mortgage. All right, so the number one pro is that it is a shorter path to home ownership. Owning a home is safe, okay? So let's just suppose you're 30. If you do a 15-year mortgage and you're making your minimum monthly payments on time and everything, you're not getting penalties and all that other stuff, you'll have it paid off by the time you're 45. That's great, you know what I'm saying? 45, you can chill. A house, that's probably the largest debt that you'll come across unless you've just been going to school back to back to back. Then you probably have student loan debt that's more than your mortgage. But a house, for most of us, that's going to be our largest debt. So paying it off quicker, you're secure. You have that house. You don't have to worry about rent. You don't have to worry about paying stuff up. Now, of course, even though you pay off your house, you still have to pay taxes and homeowners insurance. But that's really not that much. You know what I'm saying? Depending on where you live, like your taxes, it won't be that. It won't be that bad. You know what I'm saying? You can pay them throughout the year. It's not that much. It's not much in the grand scheme of things if your house is paid off. Okay. Boop. So yeah, shorter path to home ownership. All right, so another pro of a 15-year mortgage is that you build equity faster. Now you may be wondering, what is equity? What is this? To build equity in a home? Equity is basically your interest in a home or how much of the house that you actually own. Suppose you buy a house for $200,000 and you make a 20% down payment. 20% would be $40,000. So, and you get a loan for $160,000. So basically, you only own 20% of the house. So you have 20%, or not 20%, but you have $40,000 of equity in the house, which isn't really that much. Like, I mean, you own the house, but it's like the bank owns most of it, so you don't have that much equity. But if you had a 15-year mortgage, you'd be making larger payments and you'd be able to pay it down quicker, so you get more equity in the house. And finally, the last pro, there may be more, but I'm just reading this off of this. You're going to save money. So lenders, they're exposed to fewer years of risk on a 15-year mortgage. They say 15-year mortgage is cheaper because you pay interest over half as many years as with the 30-year mortgage. So there's not as much interest being paid because it's half of 30. So this example right here. So based off a $250,000 mortgage, a 30-year, based off of the current interest rate they're given, is at 3.88% for a 30-year fixed rate mortgage. So if your monthly payments are $1,176, your total interest cost would be $173,471. So basically, you're paying for another house in interest. Like another nice house. You know what I'm saying? Another decent house. Like your $250,000 house, it may be in, we'll say Cordova. But then with your interest, you could buy a house in like East Memphis, like in the Colonial Acres area. You know what I'm saying? Which is still nice. So yeah, $173,000 in interest payments with a 30-year mortgage. Now, if you got a 15-year mortgage with the interest rate of 3.9%. You have monthly payments of $1,749, which is more, of course, a month. Your total interest cost would be $64,890, which is, you could buy a nice little investment home or just a regular home in like Raleigh or something, maybe even Whitehaven. You could still live in a house like that, but as bougie as we are nowadays, you don't want to live in a house like that. I'd live in a house like that as long as the neighborhood was nice. But yeah, so $64,000. So you could buy yourself an investment home. You've paid off your mortgage, and you could have bought an investment home in interest. But I mean, it's less interest. So you have a total savings of like $108,000 if you kept the loans for their entire terms. So 15-year, you save money, you build equity faster, and you own your house quicker. Those are the pros. Now, what are the cons? Because there's always a con.